The essence, and that's the theme of today. So I'll kick off. Good morning, everyone. We're thrilled here at SolarKal to co-host this webinar along with Dorian Hunt, partner and head of the Energy and Renewables tax practice at Berwick. Dorian has over 20 years of experience in tax credit monetization, working with developers, investors, lenders, and insurers across the renewable energy space. He's a true thought leader in this field, and we're fortunate to have his perspective as we break down Treasury's new ITC guidance. We've all been getting a lot of questions from our clients on how to navigate the ITC this year with all of the big, beautiful Bill Act and Treasury changes that are happening at a rapid pace. So Leo Berwick is an expert in that space. And some quick housekeeping. We'll field all questions at the very end for Q&A. And just so everyone knows, the webinar is being recorded, and we'll send you that recording within a day or so of the webinar. Okay, into the agenda. We'll today do some quick intros, update you on the post-Treasury and executive order policy landscape, what that means for the commercial real estate industry, some of the tax specifics of that, and then most importantly, some recommendations on forward strategy. Dorian, I'll let you introduce yourself.
Thanks so much for having me here today, Neil. I'm really excited to speak with the audience on these issues. And again, I'm Dorian Hunt, partner, head of renewables and energy tax here at Berwick. We're a sector-focused M&A and developer tax equity advisory firm that is effectively a one-stop shop for most of the work streams that are going to be attendant to structuring deals, claiming credits, understanding the credits that are available, monetizing those credits, and seeing transactions through, and curating ownership of assets, to the end of their life cycle. So I've been focused on renewables credits and their monetization and tax equity structuring for about 20 years, and other forms of credit monetization prior to that. So we are deep in the history of what's happened, and that gives us a lens, we believe, as to understand and speculate confidently as to where things might be going.
Great. And I'm Neil Sharma, co-founder and chief commercial officer here at SolarKal. I've been with the company since its start in 2016, and I've mostly focused on the client side of our business, so the real estate owners for all of those years. And then you'll hear more on the next slide, but SolarKal is the leading advisor of commercial solar to the real estate industry.
Yep, and here at Berwick, we do have that sector focus. So we're energy and infrastructure primarily, and our teams are assembled around that premise. So there's been a long history of incentives around energy, whether they be renewables or traditional or energy transition, and we execute across all of those concepts that are attendant to the credit determination and monetization. So like I said, is it transaction structuring you need help with? Is it assistance interfacing with the tax insurance market, or helping to engage stakeholders, or looking at acquisitions and how to think about the underlying attributes of those and what you're getting into? And we have a really carefully curated, assembled team of professionals who have fastballs in all of those relevant disciplines.
Great. And as I mentioned before, SolarKal is the leading commercial solar advisor to real estate owners and the largest marketplace of commercial solar vendors. We've got a marketplace of over 200 solar vendors, and that allows us to tap the right vendor for any given project and distill to the best pricing. So that gives us an outsized conversion rate and significant price improvement for all of the deals we handle for our clients. And we've overseen a lot of, pick your number, megawatts or transaction value or square footage of solar projects. Okay, so we're going to do this as a Q&A between Dorian and me. Dorian, I get to put you in the spotlight first. What do Treasury's new ITC rules really mean for commercial real estate owners and investors?
Yeah, so it's a good question. So maybe it makes sense to just briefly talk about the cadence of changes, of recent changes, because it's been as you alluded to earlier, it's been moving very quickly. The policy landscape and the incentive landscape in particular, as it relates to wind and solar and other renewable energy transition assets. So I think the starting point, the big changes we first saw were on July 4th with the enactment of the One Big Beautiful Bill Act, which codified a number of changes related to how to think about the availability of credits and their phase out schedules and the premises around what it means to begin construction, et cetera. And then on the heels of that, on July 7th, an executive order was issued telegraphing the release of guidance clarifying what it means to begin construction on one of these assets. And as you likely know, the beginning of construction date or the start of construction date, it informs a number of aspects of the calculation around what amount of credit might be available. And after that executive order, there were 45 days for Treasury to issue updated guidance, and that guidance came on August 15th. That start of construction guidance on August 15th, which changed the game a little bit for how we go about that start of construction effort. So and we'll go deeper into this a little bit later, but it's more the big picture headline punchline is more restrictions around the availability of using the 5% safe harbor, as they call it, to start construction. So having said that, just a couple nuts and bolts basics. The investment tax credit rate is 6% by default, but then you get a 5 times multiplier if you are under 1 megawatt or you meet what they call the prevailing wage and apprenticeship requirements for the construction, alteration, and repair of the project. You get up to 30%. And then beyond that, there are things like adders, which we'll talk about a little bit for, additional incentive amount for having domestic content or being located in an energy community or benefiting low income communities, that sort of thing. But for this purpose, 30% is kind of the threshold applicable percentage for ITC determination. So start of construction, what does it mean? What are the implications of starting construction on a certain date? So ideally, being able to demonstrate a start of construction before the end of this calendar year is helpful because it gives us 4 years of runway to place the asset in service, and it allows us to avoid what they call the foreign entity of concern material assistance limitations. Now, if you start construction between January 1, 26 and July 4th, 26, the beginning of next year, the first half of next year, then you're still going to have that 4 years to place in service, but you're going to have to think about, okay, how do foreign entity of concern material assistance limitations come into play for my project? So and then beyond that, if you have a start of construction beyond that date, it becomes our place in service deadline becomes drop dead at the end of 2027. So there's a lot of appetite and a lot of activity in the market around starting construction. Now, the guidance that came out on August 15th, as I mentioned before, it gives us kind of a tighter, more restrictions on starting construction. So the idea of using either the 5% safe harbor or physical work was maintained, but the 5% safe harbor is now going forward only going to be available for those projects, the solar projects that are below 1.5 megawatts AC. And there's rules around how to calculate that specifically, but what I'm seeing in the market is just a pivot in terms of strategy as it relates to start of construction to be responsive to these rules. So a lot of rooftop deals are going to be well under that limit, and 5% safe harbor is still on the table if you can procure enough equipment. But generally, physical work, generally across the asset class, physical work is going to be the path forward for most projects. Now, just a note about domestic content. So we talk about domestic content. It's one of the adders, one of the three I mentioned, and I think it's particularly relevant because the domestic content guidance that we have now is serving as a proxy and a placeholder for how to interpret the foreign entity of concern material assistance limitations. So we recommend getting up to speed and being familiar with what they call the new updated elective safe harbor for domestic content, because that's kind of the guidance we have to work with for navigating foreign entity of concern material assistance limitations. But effectively what it comes down to, whether you're looking at domestic content adder or you're looking at foreign entity of concern issues, there's this escalating ratio of requirements for equipment that need to be sourced from certain places. So if you're trying to get domestic content adder and you start construction, prior to the commencement of next calendar year, you need to be able to demonstrate that 45% of your project is composed of domestically sourced materials. Now, on the other hand, if you're using that guidance for foreign entity of concern rules, then it's the equipment you procure to pass the test doesn't have to necessarily be domestic. It just needs to be from non-foreign entities of concern. So there's depending on which lens you're looking at the project through, there might be different thresholds that you need to apply and different ways to think about that. So here we have a nice visual. If I can be so bold to say that kind of gives us a flow chart to navigate these new start of construction rules that were put into place on August 15th. So as I said, if you have a small project, right, and that's defined as a low output facility, as they call it, and that's below 1.5 megawatts AC, then you're going to have the optionality, do 5% safe harbor, which means like, okay, I'm going to spend, at least 5% of the total eventual project cost basis at the point I'm trying to demonstrate that I've started construction, or you can do the physical work test, which is more of a qualitative test that has to do with engaging in the activity of construction of the facility in earnest, whether that be on-site or off-site. But then now, if we have a larger project, one of those, bigger than that 1.5 megawatt threshold, physical work is the only game in town. Now, even though the rules have changed, around the edges in this way, this guidance around what it means to begin construction has been in this form broadly since the 1603 grant days back in 2008 or something. So there's a real depth of expertise within our firm around navigating those rules, and we've carefully monitored the continuing evolution of those, and will continue to, as it's clear start of construction is going to be relevant for credit determination. Now, okay, so the new guidance, what does it mean to have the 5% safe harbor, and what does it mean to begin significant physical work? So 5% safe harbor is think about it. If you have a project that costs $100, that's going to cost $100 when it's eventually in service. If you're below that 1.5 megawatt threshold, then you spend $5 on energy property, let's say modules, trackers, inverters, that sort of thing, then you're able to pass the 5% safe harbor. Now, one of the things about the 5% safe harbor that can take people unaware is the idea that you don't really know if you've passed the 5% safe harbor until you know the final cost basis of the asset. So things like fair market value step-ups in the context of tax equity transactions, or cost overruns, right? That can blow the test, and you would not know that until you're finally in service. So there is an appeal to the quantitative nature of the 5% test, but it's not without its difficulties, right? And ambiguities. Now, significant work, on the other hand, the ambiguity is a little bit different in that it relies on subjective definitions around what it means to be significant in terms of the physical work that has been performed. So, over the years, the definition of significant among tax advisors and counsel has been evolving and been refined. So again, there's a pretty good understanding across the market, a pretty good consistent understanding, as far as I can tell, about what significant means for physical work. And again, as I mentioned, it can be on-site or off-site. So on-site physical work means that you're at the site, like let's say you're digging foundations or building O&M roads or something like that. Or it can be you've engaged with a vendor to produce a custom piece of equipment that's site specific, let's say like a generating step-up transformer or something like that. that's going to be installed in the project. So the physical work test can be appealing. Well, it's appealing when it's the only option in town when you're over 1.5 megawatts, but it can also be appealing because sometimes there's less capital outlay upfront than would be implied by using the 5% test. So there's either path needs to be navigated carefully. Now, uh, there's something we need to think about in terms of what it means to be a single project, right? And those rules have been moving and changing prior even to the One Big Beautiful Bill Act. So with the Inflation Reduction Act that came out in 2022, a new what they call tech neutral credit regime was scheduled to be put in place on January 1, 2025, and it was. And if you're looking at ITCs, for the most part, you're probably in what they call Section 48 Cap E, which makes a distinction between what's a qualified facility and an energy storage technology, right? So if you have things like co-located batteries with your solar, you're looking at two different projects, right? You're looking at a solar qualified facility and you're looking at an energy storage technology, and you're going to look at all these tests, the availability of adders, the fulfillment of prevailing wage and apprenticeship, et cetera, et cetera. You're going to look at those on an isolated basis. Whereas prior to that, if you were in the old credit regime, oftentimes we'd see storage property deemed to be solar property and treated as one monolithic unit, and the requirements were applied on that monolithic unit. So we're in a little bit of a different world now. Like I said, even before the One Big Beautiful Bill. What does it mean if you're looking at the solar piece of your project? Even within that, there's this concept of units of energy property or units of qualified facility. So, and that's going to vary. What that means is really going to be asset class dependent. So, if you're in the world of solar, a unit of qualified facility, that's going to be the envelope around which you determine your credit availability is probably going to be something like a string of panels and an inverter, some functionally interdependent chain of equipment that can produce usable electricity. When we're thinking about phasing in additional strings and upsizing projects, we want to be careful that we're navigating those definitions and making sure that we're performing incremental additions in such a way so as to be respectful of what they call the 80/20 rules, which is basically retrofits to existing projects and what threshold needs to be met in order for that project to be considered new after retrofits and therefore generate credit. So there's a whole science around navigating that, and it should not be taken for granted. Foreign entities of concern, I'll talk about that a little bit. And I tend to think of it part and parcel with domestic content. But again, domestic content is a bonus adder, right? It's a carrot, whereas foreign entities of concern limitations, that's a stick, right? So one's a benefit and one's a bust, right? So foreign entities of concern, I'm seeing a lot of chatter, and I'm advising many clients on how to think about taking a fresh look at supply chains and understanding where things are coming from, and understanding what your projects are going to be, how foreign entity of concern is going to implicate those projects. So there's a real connection there. So if I could ask you, Neil, what are you seeing in the marketplace in terms of the response to one big
Yeah, yeah. You mentioned that policy's moving fast this year. For those of us old enough to remember the first Star Wars, it's a light speed year of policy. And like the main trend or reaction to all the policy changes, whether it's from our clients or our vendors, or in terms of pricing or your policy at the state level, it's urgency. Clients are accelerating the green lighting of their projects. Vendors are bidding more competitively. Pricing's holding for now. It's a bit of a black box how long that lasts. And then states have been ramping up their support for solar in light of the federal support eclipsing. So Massachusetts, New Jersey, Illinois, all with recent announcements. And I'd also call out Maryland and New York. So this is all just happening at a rapid clip.
Yeah.
Um, so with a marketplace of 200 vendors at SolarKal, we have a pulse on what they're doing. We're talking to them every day, and the vast majority, via polling that our marketing department did, 84% of our vendors are crystallizing safe harbor strategies, including stockpiling of solar panels, strategies to help meet starter construction requirements that Dorian you just kind of outlined in great detail, like this notion of safe harbor strategy makes vendor selection even more crucial. It was always crucial. The fit of a vendor to the snowflake of a solar project was always important, but now like it's snowflake on steroids. And so vendor selection and their safe harbor strategies, that's important. And I'm just going to keep on hammering it in that time is of the essence. So um, in terms, like SolarKal is a marketplace. We have clients and our developer or vendor marketplace or vendor side of the marketplace. We're always working to optimize both sides of that. For our clients, we're helping to identify the vendors for their projects that have the most appropriate safe harbor strategies. That's number one. Two, we're trying to condense timelines. We're streamlining, we're compressing. Contracting is one of several examples of where we have strategies in place to just shorten the cycle. And then three, we're ensuring that we're examining any client's real estate portfolio through this new lens of capturing the remaining ITC window. So the game's changed a bit. It's the same game, but it's like fourth quarter, and we're paying attention to that. On the vendor side, we're delivering projects in their sweet spot. We've always done that, but now again, it's even more kind of crucial. Secondly, we're using that streamlined process to accelerate approvals on that vendor side. So contracting, I'm going to keep on using that as an example. But both sides of the equation, a negotiation or contract is a negotiation between two sides. SolarKal's figured out some strategies to shorten both sides. And then thirdly, we're overall adding efficiency between that client and vendor match, ensuring that projects convert quickly, and quick conversion is what's key in this eclipsing ITC window. Um, okay, so on to the third question. From a tax compliance perspective, Dorian, what are the key things commercial real estate owners and project developers need to keep in mind right now to capture the maximum ITC benefit under the new rules?
Yeah, it's a great question. So I think that I sound like a broken record probably, but start construction, it's crucial understanding exactly how that needs to take place and how the rules are evolving and being aware of the start of construction guidance that has been issued, right? But that also is forthcoming. Additional start of construction guidance forthcoming as it relates to foreign entity of concern limitations. So keeping a bead on those developments as you go is crucial. So you got to know the rules of the game to play it, first of all. And depending on the start of construction path you take, there's going to be different best practices that are going to apply. So if you're in the 5% safe harbor world, understanding the rules around what it means to accrue costs to get that into the start of your capex that's going to be includable in start of construction. So you want to be careful to make sure that you're counting only those things that are capitalized expenditures and they're capitalized on your tax return and not deducted or something, and they're going to end up in the eventual energy property basis. Making sure you have invoices, POs, and you're familiar with the economic performance rules under Code Section 461 to be able to do those accruals appropriately. And you want detailed tracking, and the best practices at the serial number level, right? To understand, okay, I ordered these things, these panels, these modules, and they had these assigned serial numbers, and these are the ones that made it to site X, and therefore site X has demonstrated a start of construction on that premise, and understanding okay, when are deliveries going to take place? If deliveries can't take place, is there another way to demonstrate economic performance? Can I get title and risk of loss to something that's sitting in a warehouse from the vendor that's isolated and identified for me? And how do I get confidence that is on track? And understanding, of course, the project construction timeline is crucial to know when you can have site access. For example, is there even an opportunity to begin physical work? Do you have site access, or is that just off the table? And you have to look at things like offsite physical work, or are you small enough to appeal to the 5% safe harbor still? But in all cases, I find that the biggest the most important thing is contemporaneous documentation around all this, no matter which path you take. So it's a lot about being disciplined in aggregating all your documentation and your data as you go, because I've seen many instances where you try to backfill and take a retrospective look and try to rebuild the past, and that's often it's always painful and difficult to do so. So contemporaneous record keeping, data collection, maintenance of files, and sensitized to the start of construction path you're taking. And yeah, so we talk about single phase versus multi-phase projects. So when we talk about this 1.5 megawatt limitation, for example, one of the questions I get a lot is okay, well, can I just say, I have each one of my units of qualified facility is below that 1.5 megawatt threshold. Am I good? Have I avoided these rules? And the answer is probably no, because those things that are separate for some purposes, for example, 48 cap E, as I described, and the availability of adders, et cetera, as it relates to the ability to use the 5% safe harbor, those units of qualified facility are going to get aggregated, and their nameplate capacities are going to get summed up, and in a lot of cases push you over that 1.5 megawatt threshold and destroy your efforts to start construction through the 5% safe harbor. So the the uh, uh, the punchline is that the the fulfillment of and the execution of a successful project is not well, it's a combination of engineering, of design, and tax and financial and commercial advisory, right? So all those things need to hang together and work in coordination with one another in order for this to be successful. Um, yeah, and now so there's things we can do to manage our risks, right, and maximize our value. So again, audit trails, documentation, planning in buffers for slippage in place and service or cost overruns. Instead of a 5% safe harbor, maybe you want to spend 7% to make sure you have a little buffer for things like that. And thinking about, okay, if I have these incentives, how are they being monetized? So if you're in the lessee position, they're monetized in one way through the value of the owner of the project and their ability to claim ITCs. But if you're the owner of the project, you're generating the ITCs. Can you use them yourself to offset your tax liability? Or do you want to think about selling them? Or is it worthwhile to maybe pursue a tax equity transaction where you're monetizing, some cash flow, some depreciation, as well as the incentives? And one of the things that's a constant now I've seen and really ballooned after the introduction of transferability of credits with the IRA is this concept of tax insurance. So it's not P&C insurance. It's a different product that is built around the tax risks that might lead to either a disallowance or a recapture of credits that you thought might be available. And yeah, so as you're working through this, I appreciate Neil the opportunity to talk about what we do a little bit. But I said a bit up front: modeling, structuring, advisory, tax opinions, financial diligence, sell side diligence or buy side diligence, valuation, cost segregation, pretty much everything that you might need to extract the value from these credits and optimize your portfolio of projects in this way. So they're always happy to help. And here's just a laundry list of what we do in this space. And we're not bound to just the things listed here. We have a really diverse set of professionals that can deal with edge cases and think around the corners, for whatever may be of interest. So please reach out.
Yeah. Oh, you're up first on the final tips,
Yeah.
Dorian.
Yeah. So, get started early. Don't wait. There's plenty of traps for the unwary. And, I find that just early involvement is the best way to get ahead of everything. Stay organized, document everything. Again, contemporaneous documentation, right?
And I too am going to sound like my broken Pink Floyd record. One, two, three. One, start now. Deadlines are real. Two, choose the right developer. Three, choose the right properties. And SolarKal can help with all of that. Okay, so let's see. Uh, One question that came through is to you, Dorian, is 45x from the manufacturer with a question mark.
So 45X, that is the production tax credit for the manufacture of a list of components, things like, whether they be solar modules or battery cells or advanced critical minerals, right? And I think the 45X is already doing its work along with 48 Cap C to help build out that domestic supply chain. But it's of course it's not immediate, and it's going to be gradual, and it remains to be seen. I think the extent to which the availability of incentives like that is going to help the supply chain be more domestically sourced.
There were a couple pre-questions, but I know we're at time, so we'll answer those at a later date. So if you wanted to contact Dorian, that was the contact info. Then, of course, there's myself. And thanks for joining today.
Thanks all. Thanks again for having me, Neil.
Thanks, everyone.